Mr. Gujral, good morning. Well, the numbers this time around were a bit of a miss versus the street expectation, especially with respect to the kind of gross margin performance that we have seen. It's missed the mark quite substantially. Could you talk to us about what went wrong and what's the way forward for both the gross margin and the EBITDA margin?
Good morning. We had guided, so they have guided the street about our turnover growth of about 50 odd %, with margins stabilizing at about 7%. They missed it by about 0.2%. And this is essentially because of the product mix and a very high capex which we have done over the period. I have almost doubled my capacity of SMT in the current year. What I had built over the last 30 years, three decades plus, has been replicated in one single year, which has resulted in the expenses, the operating expenses going up. Despite that, I have had a 1.5% operating leverage. So this only is a sort of indication that going forward in the coming year, we would be in a better position, where we are guiding a growth of about 40-45%, same as per last year, and EBITDA margins to stabilize at about 7%.
Your revenue growth was driven by consumer, healthcare, automotive, and industrials. Where do you see the maximum growth in FY25?
FY25 would see a secular growth because the consumer has gone up substantially. Automotive went up about 60%, consumer went up by about 85-90%. In the coming year, FY25, I expect my consumer business to be below 40% of my revenue. Currently, it is 40%. Automotive would be about 21%, industrial about 25%. Healthcare would constitute 8% of the higher sort of top line growth. So it would be led by, as it has been in the past, by industrial, auto, and consumer.
Mr. Gujral, the other big worry apart from the margin front was the net working capital and the kind of increase that we have seen there, because at the start of the year, you had guided for 70 days by the end of the year. You've actually ended at 95. I understand that you did capex and, the overall capacity, etc. has gone up. But what about the coming year? What could you bring down those net working capital days to now?
Working capital days as of March of 24 are 70 days and not 90. I don't know from where you've got the figure. Now, if I was to, we hit a run rate of 1,000 crore rupees of revenue in quarter 4 of FY24. Now, the working capital is built for the futuristic next quarter turnover. So if I plan to do 1,000 plus crores in Q1 of FY25, then my working capital is down to 60 days. For average for the full year, it is at 70 days. But if I take the last quarter, it is down to 60 days. Not to say that there is no further scope of improvement. The management is very seized of this issue. And that's the key, that once we are able to lower the working capital, it will result in a lower interest cost and a better cash flow. But it's not 90 days. I don't know. It's 70 days as of March of 24 on an average basis of the revenue and the inventories.
A brokerage note, sir, wherein they talk about how the net working capital days is 96 thereabouts. We'll get that checked whether there is some, kind of discrepancy in their understanding versus what you're suggesting. But just before we let you go, what's the way forward in terms of the overall, competition that we are seeing from Chinese exports? Because there's no anti-dumping duty currently. And low barrier is again something that the street is worried about. What will be your view on that?
See, we have grown and gain market share despite all this. Now, not only my overall revenue growth, my export revenue growth is 26% last year, and it has grown by about 20% compounded over the last 3 years. And with the steps which we have taken, we are beefing up our manufacturing facility in Germany, consolidating all the small facilities into one big facility to address to the nearshoring requirement of the customers. Competition will be there, but I'm not sort of losing my sleep over that. I'm more focused on sort of improving the efficiencies and improving the bottom line. The top line growth is visible and I can smell it.
Okay, so Mr. Gujral, next year 40% growth and 8% margin or 40% growth, 10% margins?
40-45% growth at 7% margin is what we are guiding the street.
But that is not
And
significantly high, no,
that's what
sir?
I've done it in last year also, midway last year also, we had corrected it. We had sort of brought it down from 8%, which we are saying, to about 7%. We stand by that and very confident that we'll achieve that in the coming year.
Is 7% impressive enough? Because like you said that you've expanded. You've put money into new, capex and opex, which means that by the second half of FY25, large amount of investment should come down. If that comes down, it will automatically start impacting your profitability and margin should go higher. So why are you saying 7? Why not 8.5 or 9 or 10?
I'm being realistic. If we start seeing that reduction coming in, which would come in, we'll revise our guidance. I'm being conservative on that.
Okay, being a bit conservative, and quickly before we let you go, the 1,000 crore fundraise that you had done, what's the plan to utilize that? Is it all just going for capacity expansion only?
This is an enabling resolution because as we are growing and we had indicated to the street that we would be looking for inorganic acquisitions. So this is an enabling resolution so that we are prepared that should an opportunity for an inorganic acquisition or a diversification come in, would use that. It's more of an enabling resolution rather than anything targeted to a specific project as of date.
Only an enabling resolution. Thanks, Mr. Gujral, for making time and speaking with us, and have a good day ahead.
If you like this video, then like, share and subscribe to ET Now.